Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
All right, so everyone, welcome to the second In Conversation with series. Good afternoon and good day to everyone who's joining us outside of Europe. My name is Gaurav Tomar, and I serve as the Chief Marketing Officer at the German Indian Forum, or GIBF in short. In my day job, I work as an automotive industry manager at MathWorks, who are the makers of MATLAB and Simulink. GIBF, or German Indian Business Forum, is organized in Munich together with the Government of India, the Bavarian Ministry of Economic Affairs, Energy and Technology, the City of Munich, the Confederation of Indian Industries, and OAV, which is German Asia Pacific Business Association. This forum consists of events such as Startup Connector, business conferences, and evening receptions. And these events offer a sustainable dialogue platform to top decision makers from the areas of business policy making and administration from Germany and from India. In the past, we've done these events, of course, in person, but this time circumstances are different. So GIBF has started with this online series of which is called In Conversations With, where you will hear and interact with industry leaders and startups in smart logistics and mobility space. And they will share their stories, discuss relevant challenges, and propose solutions or pitch their ideas to coaches and investors. Today, we have a dignitary today in our presence, Mr. Dr. Andreas Rees. And he's going to, on the next slide, we have the agenda. So Dr. Andreas Rees is the Chief German Economist at UniCredit, which is a well-known financial organization and a bank worldwide. And he's based out of Munich, based out of Frankfurt, apologies. His research focus is Germany and the eurozone. Mr. Rees has 23 years of work experience from a macro, policy, and FIFX perspective. Mr. Rees holds a master's degree and a Ph.D. in economics. Dr. Rees, thank you very much for joining us today. Also, to do the Q&A today, we have Mr. Holger Frank, who has been the head of UniCredit International Center at Germany since 2019. And before that, he headed institutions and transactional business in Asia, where he was responsible also for India. So he's now responsible for strategic business development of international business relations for corporates in Germany within the UniCredit group. Dr. Rees, Mr. Frank, both of you, welcome to GIBF. Thank you for joining the In Conversation With event. And we are really looking forward to your presentation, Dr. Rees, on the economic outlook and how do we get out of this 2020 trough. Over to you, Dr. Rees.
Okay, thank you very much, Gaurav. I'm pleased to be here and to do the presentation in the next 25 to 30 minutes or so. I would like to deal in the beginning with a short global outlook update on the global economy, and then I would like to switch over to the US and especially the state of affairs in Europe and also, of course, in Germany. I would also like to deal at least briefly with some general topics such as fiscal policy or the latest results from the EU summit, which is certainly very interesting and hopefully also topical. I would like to start with the global economy and with my first slide. Yes, thank you very much. Here, what you can see in this slide is our proprietary global leading indicator. It consists of 10 sub-indicators from the US, from Europe, and emerging Asia. And yeah, it's some kind of meta indicator which comprises all different information from various countries, regions, and also sectors. When you look at the latest development, the latest pattern, you can see this sharp rebound. That means we have seen hopefully the trough in April of this year. So the global economy was massively hit by the shock, by the coronavirus shock. And for instance, if you compare it with the global financial crisis about 10 years ago, we have seen the trough after the Lehman collapse, the trough the trough in the shock to the global economy after Lehman at the beginning of 2009. And if you compare this level with the level we have seen in April of this year, the shock was about 3 times more pronounced than the shock we have seen after the global financial crisis about 10 years ago. And I think this says a lot. The latest data we have currently, that's still June. In about 2 weeks' time, we are getting the July figure. We are updating our indicator on a monthly basis. And so if you look at the latest pattern, it looks a bit like a V-shaped recovery. That means after the shock, a rather strong rebound. However, if you look at the June level, and that's, I think, interesting to see, the June level was still somewhat below the level we have seen in January 2009. That means the shock in June, despite the latest recovery, the shock in June was still more pronounced, more nasty than the trough we have seen, the maximum shock after the Lehman collapse during the global financial crisis. And this, I think, says a lot. Hopefully, and I think this is also likely, hopefully we are getting a further recovery in the global economy. However, there are certainly some risks further down the road. And of course, I think most of the risk come from the US. If we can go to the next slide, please. Of course, you know it, but just for illustration, the rise in virus cases in the US has been getting more and more sharp in the previous weeks. And what you can see in this slide is the number of virus cases per 100,000 inhabitants. So in the US currently we have about 20 cases, and in the European Union, excluding the UK, it's below 1. So there is really a sharp, there has been really a sharp divergence between the European Union and the United States. And I think from an EU's perspective, the EU has been, I think, following comparatively strictly to the advice of health experts in contrast to what happened in the United States. The Trump administration has been repeatedly pointing out that this number of increasing virus cases is of minor importance in the view of the Trump administration, at least, because the number of deaths fortunately have not been following this sharp increase, but nevertheless deaths have been rising in the US, and I think this is a very, very sad pattern we have recently witnessed. And given the rise in the virus cases, there are a lot of risks, not only to human beings in the US, but also, of course, to economic activity. So most of the downside risks, I think, currently come from the US economy. And it can also be illustrated by timely available indicator. That would be my next slide. It's a rather, let's say, unconventional indicator, but I think given the extraordinary circumstances, it makes a lot of sense to look at this indicator. It tells you a lot about social distancing and also the speed of the recovery in the US, but also in some parts of Europe. In this slide, I compared the number of walk-ins and reservations in seated diners. It's available on the internet. It is regularly published by Open Table. You can see the figure for Germany, but also for the US on a yearly basis. And as I just said, it's timely available. That means we now have the data, let's say, for the third week of July 2020, and the figure is on a year-on-year basis. That means July 2020 compared to July 2019. If you look at the pattern for Germany, you can see a rather sharp rise over the last few weeks with some, of course, volatility. But in the meantime, the activity in German restaurants has even been a bit higher currently than in July 2019. When you look at the pattern in the US, we have been stagnating at a rather low level. Activities have been about 60% down compared on a year-on-year basis. And this indicator is really interesting, as I just said, I think, because it measures indirectly, of course, the extent of lockdowns in some US states. And it also measures the voluntary social distancing by people in the US, because if you are afraid to get the disease, to get the virus, then of course you are not going to a restaurant. So I think it's a really interesting but also a bit scary indicator, and I think this indicator needs to be closely watched in the next few weeks, how it develops, and you can make some, I think, important conclusions from this indicator. So to cut a long story short, I think there are certainly downside risks for the US economy, especially when it comes to the services sector, not only to restaurants, but probably also to services. And of course, as you know, services is a lot about face-to-face interaction. And here I think that Europe did a far better deal in handling the crisis so far, at least, than the US. If we go to the next slide, that's about the fiscal policy response of the US compared to many European countries. What we did in this chart, we put all these measures together in % of national GDP. As you can see, typically there are 2, or in the case of Germany, 3 responses by the government when it comes to fiscal policy. First of all, the classic response, more spending and tax cuts or tax deferrals, especially for companies, to soften the blow to economic activity. Then we have guarantees, that means public guarantees for bank lending directly to companies in some countries, or which is more often the case indirectly through the banking system, for instance in Germany, through commercial banks or public banks, and then KfW, Kreditanstalt für Wiederaufbau, the public banking entity in Germany. And then in the case of Germany, a specialty, the stabilization fund, that means the government is in the process of creating a stabilization fund which could directly take stakes in companies. And as you know, the government recently announced, for instance, to take a stake in Lufthansa. When you compare these measures, then you can see that I think it's fair to say that Germany is best of class. The response of the German government was massive. In total, we have seen a fiscal response of about 40% of German GDP, 40%. If you compare it to other countries, then you can see It has been less pronounced in some other European countries, but it's still massive. For instance, in the UK or in Italy or in France. And if you compare it to the US, there you can see that many European countries that they are, let's say in quotation mark, that many European countries, they are trumping the US. That means the fiscal response has been far more pronounced, at least so far, than compared to the US. Also, the composition of the fiscal packages in many European countries is different compared to the US. In the US, there has been more direct spending and tax cuts, tax deferrals, whereas in some European countries, typically there has been more public guarantees to lending activity of banks. So all in all, I think it's fair to say that Europe handled the crisis better in a sense that they followed the expert opinions of health officials or health experts, and also the handling, the fiscal policy response of government was also better or more massive, more pronounced than in the US. And I think this is, given the extraordinary circumstances, in my opinion, this is appropriate. So can we go to the next slide? Unfortunately, I cannot see the slide anymore. I have to go to my iPad, sorry, to look it up. Just a second.
I think the screen.
Oh, okay. Now here it is again.
Yeah.
Okay. Can we just go back to the next slide after the slide, the fiscal policy response and the rescue packages? That would be government debt. Yeah, no problem. I just keep on talking a bit because many people, if you look at this heavy fiscal response, many people just ask, I mean, can governments afford this huge response? I mean, is it wise to do it? Is it wise to react in such a heavy manner? And I think, as I just said, it's appropriate because we are in a deep recession in many countries. If you can go to the next slide, please. There you can see the public debt level. There are two charts. On the left-hand side, you can see the public debt level, and hopefully we can go to the next slide. You can see the public debt level, which has already been high even before the coronavirus crisis in 2019. Thank you. That's the chart on the left-hand side, and the chart on the right-hand side, and I will explain it soon. That's the public interest payment by governments in percent of GDP. But let me just go back to the left-hand chart. There you can see the government debt level in percent of national GDP. As I just said, these are the 2019 figures, and in many countries it has already been very high. And I think, needless to say, government debt will of course increase further in 2020 and in all probability in 2021, because you do not only have the fiscal policy response, but also the loss in tax revenues. Unemployment has already been rising, so there the burden on the public budget in many countries will significantly increase. So the question is, what's too much? I mean, is it still sustainable, or are we going to see a collapse of some countries, of some governments, because they cannot serve the high government debt level? First of all, I think it is important to acknowledge that there isn't any magic level at which the government debt level is becoming too high. I mean, you cannot say it. For instance, one example is Japan. where the government debt level has already been close to 250% of Japanese GDP already last year. Very high, but there hasn't been any collapse so far. When it comes to Europe, one example is Italy, where the government debt level has been about 135% of GDP. But even in the US or some other European countries, we have seen a debt level of roughly 100%. The only exemption here is, as you know, Germany, where the debt level has only been roughly about 60% of GDP. So there isn't any magic level. And let's say my advice as an economist is, do not look too much at these figures in the left-hand chart, but what is more important is, and I think what many people just forget, what is more important is that you have to look at the interest burden. That means how high is the public interest payment in percent, let's say, of tax revenues, or probably also important, in percent of national GDP. This is the decisive figure, and looking at this figure, I think, helps you in getting a sound assessment on whether the high debt level is sustainable or not. It does not help when you just look at the debt level. It does not say you too much. You have to look at the interest burden. When you look at the chart on the right-hand side, it's a development, let's say, over the last, even 50 years for some countries, how high the interest burden has been. And I think it's really important to understand that. For instance, in the case of Italy, the interest burden has in the past even been far higher, 2 or 3 times higher than last year, for instance. So, as is the case for many companies or private households, you always think of how high is my interest burden in terms of my income, or in terms of what I earn, or in terms of corporate profits. And this also applies, this idea, to the government debt level. Of course, the interest burden will increase massively this year, and also in all probability in 2020, maybe even the year after. I mean, that's a done deal, because the public budget deficits, they already started ballooning. They are increasing very strongly. However, on the other side, you have a very low interest rate level, or even in many countries, a further declining interest rate level, given the fact that many central banks has been purchasing government bonds. So to cut a long story short, I think, yes, I mean, I'm not, let's say, I do not want to say that there isn't any problem. The burden is rising, and the fiscal leeway for many governments has been getting smaller, or is getting smaller in the next few years. However, on the other side, I think it's very likely that central banks will keep the interest rate level rather low by purchasing further government bonds. It's very likely that many central banks will remain active on the government bond market in the next few years, even more active than after the global financial crisis, and they will do everything to keep the interest rate level very low. And this will also help many governments to serve the interest burden. So all in all, I think there will be some kind of a close relationship, even closer than before, between governments and central banks. That means central banks will keep on buying government bonds. They will get the interest payments, the central banks will get the interest payments from the government. And then once in a year, there will be, the central banks will transfer their, typically they make some profit given the interest payments, for instance, and then the central bank will transfer this profit back to the government. So this will be a very special relationship, even a closer one than we have seen in the last few years. And if you ask me, I think, yeah, the fiscal leeway, as I just said, has been getting already smaller, but I do not expect any bust, any bankruptcy from, let's say, from or in industrialized countries at least. I think this won't happen. If we can go to the next slide, I would now like to switch over very briefly to the European business cycle and how it looks currently. And I think if you look at this rebound we have been witnessing in the last 1 or 2 months, you can also see this, I would say, the success in Europe. It shows the success of European policymakers by containing the crisis, but also by implementing this heavy fiscal response. One rather timely available indicator is car registrations. We have the June figure. I think in about 1 week we are getting the July figure, and you can see this V-shaped recovery. We have seen car registrations down by up to 100%, especially in Spain and in Italy. So basically no activity at all, which is of course given the circumstances. But in the meantime, in May and now also recently in June, we have seen a big rebound. In France, we are now even at a pre-crisis level, which is very interesting, and it has something to do with speciality in France. The French government has been implemented a cash for clunkers program. That means you are getting a bonus payment from the government if you purchase a new car, and that's the reason why the rebound was even stronger than in other European countries. So all in all, I think it's fair to say, just as an example, we are making progress and the rebound is underway. If we can go to the next slide, I would like to show you 2 slides on Germany very briefly. This is a very interesting indicator. It's also really timely available. It is published by the German Statistical Office. It's the so-called Trough Millage Index. That means basically nearly in real time, the activity on German highways, the truck activity is measured. It's really timely available. And the idea is if you have the truck traffic on German highways, it should be a rather good or decent proxy or indicator for overall economic activity. And this is especially true for manufacturing and the construction sector, because typically in these 2 sectors, the more transportation services you need, the higher should be activity in these 2 sectors. I think it's rather not so good indicator for some services indicators, but rather, which is very important for Germany, for the huge industrial sector, it's really a decent proxy. And this can also be shown by looking at the past experience before the crisis. So what we can see in this chart, we indexed it. That means it's 100 at the start of February. And if you look at the pattern over the last 3 or 4 months, you can see we have been hit by a massive shock. We have been down by about, let's say, 17 or 18% in March, or then especially in April. But in the meantime, we have been climbing up the ladder once again. And now currently, and the latest figure I think is from about 1 week ago. We are last week we have been about -4%, still below the pre-crisis level. But the rebound was really underway, and I really encourage you to look at this indicator. As I just said, it's publicly available on the homepage of DStatis, the German statistical agency. And then to finally, before I make some conclusions about the scenarios, let me just show you very briefly, one additional slide on Germany. As you know, the fiscal response, and I think this is also very important for the outlook for the second half, the fiscal response in Germany also includes a temporary cut to the value-added tax rate. It already started at the beginning of July. The VAT has been cut from 19%, at least the standard rate, from 19% to 16%. This measure will expire at the end of December 2019. And I know that many German economists currently sound rather skeptical on this measure. I think sooner or later there will be, that's my best guess. Of course, I do not know it better than other economists, but my best guess, my gut feeling is that there will be some kind of a success here, especially when we are coming closer to the Christmas season. I think it makes sense, especially when you think about buying a new car, then you are going to do that, or furniture or a refrigerator, meaning consumer durables. It makes sense to front load this kind of consumer spending in the second half of 2020. Of course, there will be some backlash, some kind of a negative effect then probably at the start of 2021, because it's just front-loading consumer expenditures. You are not increasing your expenditures. That's unlikely, just front-loading. But I think this measure helps building a bridge to 2021, and I think it's really clever to do that. So to sum up finally, because we are running low on time, just two more slides about, let's say, the medium to longer term outlook. And of course, I do not know it better than you or other economists. We still have to speculate a bit. And I would just to focus on two scenarios. All in all, I think there are 4 scenarios roughly described at least by this V, W, U, and L shape, but I would like to focus on the 2 more likely scenarios, that's a V-shaped recovery, and then as a risk, the W. The U-shaped, that would be a longer recession and then only a recovery, and the L-shaped, I mean, that would be a worst-case scenario, something like we have seen about 100 years ago during the global economic crisis, the Great Depression. And I think that's a worst case scenario, and given the latest development, thanks God, not very likely. So in our view, we think that some kind of a skewed, that's important, a skewed V-shaped recovery is likely. That means when you look at growth rates, of course, currently we are in a deep recession. But it's likely that we are getting a recovery. This already started in the second quarter, but this recovery is still not strong enough to lift the economic levels into positive territory. This will only happen in the second half of 2020, and then also probably or hopefully in 2021. As I just said, it's a skewed V-shaped recovery in our view, because when you look at economic activity levels, it's not likely, it's rather very unlikely, I have to say, unfortunately. If you look at activity levels, we are not going back to the pre-crisis level before, in our view, before the end of 2021, or even in the first half of 2022. And of course, this has also something to do with mathematical considerations, because if you are dropping, let's say, by 10% and then increasing by, let's say, even 10%, then you are starting from a lower level, and you cannot reach, even in this optimistic scenario, you cannot simply reach the activity level before the crisis, because your growth rate is starting at this lower crisis level. And even if you look at growth rates in some countries, it's unlikely that we are getting a rebound to the same extent as we have seen the magnitude of the recession. But all in all, I think the rebound is underway. The risk is certainly, especially what I said in the beginning, risks are coming from the US, and of course, but of course it could also happen in Europe, that the pandemic, let's say after the summer break, after vacation, and maybe people are getting too careless, that the pandemic could return, and we do not know that. Hopefully it's not the case, but if you think in risks, that could result in a more or less pronounced W-shaped pattern. That means recession, the first part of the V, then a recovery, but unfortunately maybe at year end 2020 or at the start of 2021, a renewed recession because of the return of the pandemic. That's, I think, in our view currently, as of today, probably the risk, the most valid or most pronounced risk. If I just, and this is my very last slide, if I just can give you some numbers for our baseline. I mean, we expect that the global economy will shrink by a massive 6% in 2020, a rebound overall by roughly between 8 and 9%. In this case, for the global economic activity, the rebound, at least in growth rates, is stronger than the recession. This has something to do with the rebound in many emerging markets, for instance, as you can see in China, because in China there will be, on a yearly average basis this year, there will be only meager growth, but in 2021 growth will return. There will be, in our view, a strong rebound, and this will also lift a global economic activity. For the eurozone, we expect a decline of 13% this year and a rebound of about 10% in 2021. And as I just said, that's certainly true for many countries, but especially for Europe, but also for the US. If you look at economic activity levels, it will certainly take substantial time before we are returning to the pre-crisis level. Thank you very much. Sorry for talking a bit longer than I envisaged, but thanks a lot for your attention, and I would like to ask Holger to step in, or Gaurav.
Yes, no, thank you very much, Andreas. Very interesting. I have also the impression that the economists must become more creative in times of COVID. So counting seated diners or looking at the truck index, I never saw this before. So I think it's important to also look for new indicators. No, thank you very much. So my three takeaways are, from what you said, the first one, the shock is much more intense than the one from the financial crisis. And there's a huge difference also between US and EU development. Second is that the rescue packages are immense, and this will help to some kind of smoothen the impact. And on the other side, it will increase debt levels, but it was very worthwhile, I think, what you also referred to, that it's not only the absolute amount of debt or percentage, but also the percentage of interest rates payments that are necessary for it. And there I understood from you, it seems still manageable, so you are confident. And the last point is, yes, we will see, regarding the numbers, a huge decrease in GDP in the world this year, but you already see for next year also a strong rebound. So I think this is somehow optimistic. Good. We have a few minutes for a couple of questions. So if you have any questions, please use the chat function that you find on your screen to ask some questions. So Andreas is for sure happy to answer them. You can also ask them in German. If you want, we can then translate it. So we have already a number of questions. So Andreas, to you, the Big Depression came 8 years after the Spanish flu pandemic of 1919. what happened between 1921 and 1930? I guess from an economic point of view. So how did this develop? I think it's a tricky one, but can you answer it, or do you have any information on this one? So you refer to it as
a bit. I mean, I'm not. Yeah, I mean, if I understand it correctly, the question is about the historical development about 100 years ago, and probably also better you can make some comparison. And there are indeed already some papers written on that, because typically what economists, but also I think other, let's say, scientists or professionals typically do is that we do not have, of course, any clue, and you look at the past to hopefully derive some conclusions. I'm not an expert in this, but from what I understood and from what I have read is that indeed after the Spanish flu in the 1920s, there has been, at least in some countries, some W-shaped pattern in economic activity and in growth rate. So this risk scenario I just described could be applied to at least some countries back about 100 years ago. However, I think it's really tricky, as you said, to make, let's say, some strong conclusions, given the fact that, I mean, the circumstances were completely different in a sense that many governments did not have the spending power to soften the blow to economic activity, in a sense that, I mean, as you know, the First World War, the Great War, ended in 1918, and so many governments they were really basically broke, which I think is really a big difference to what is currently the case, and they could not soften the blow. But on the other hand, you may argue, and this is certainly absolutely a risk, that the return of the pandemic could, of course, result globally, but also maybe in some countries, it could result in a W-shaped pattern when it comes to growth rates or even economic activity levels. And of course, if it in a worst case, or in a, let's say, in a pronounced risk scenario, if this really going to happen, for instance, in the US, and given the fact that the US economy is so crucial for the global economic activity, the risk is that this would not only happen in the US, but it could spill over to the rest of the world. And yeah, in a worst case scenario, this could have severe negative implications also for Europe and many emerging markets.
Okay, no, thank you, Andreas. I think we only have time for one last question. We are getting more and more questions, and in this context, I can only encourage you to also perhaps approach Andreas. You see his contact details in the presentation also afterwards, so he will be happy for sure to answer them. One question here, and as I said, there is a number of questions, but let me take one more. What do you think is a realistic timeline until when the economic recovery will be back to the pre-crisis level in Germany and eurozone? So you gave some kind of indication, but perhaps you can give a brief answer on this. When will we be back to the numbers of 2019?
Yeah, I think it's basically the same for Germany and the eurozone as a whole. Some countries, such as Italy and Spain, may differ, let's say, by a few months or 1 or 2 quarters. But overall, we expect that Germany and also the eurozone as a whole, as I just said, I mean, it's likely that these countries or this region will return to the pre-crisis level in the first half of 2022. So it will take substantial. It will really take substantial time, and maybe we are a bit more pessimistic than competitors, but overall, it's, I think, in my understanding, when I look at the various forecasts, you can discuss whether it is at year end 2021 or the first or the second quarter of 2022.
Okay. No, thank you very much. And perhaps also we get more questions, so we will also forward the questions that you raised in the chat also to Andreas in writing, so he can come back to you, because we see your names also. So thank you very much to all of them. And yes, sorry that we don't have more time. For sure, we could spend much more. But I thank you very much for this, Andreas, for your part, but also to all the participants for the questions. Now I hand over to Gawa for the final remarks.
Andreas and Holger, thank you very much. So I feel in my past experience, the presentations that help you do your own research and entice you to do your own research are the great ones. And I think this presentation certainly checks those boxes, because I was very actively searching in the background on different metrics that you were showing today, especially the Trough index. Another metric that is probably useful is the Google's community mobility report, or Mobilitätsbericht zur Corona-Krise. So I think that is also quite interesting to see how people mobility has picked up. So yeah, a takeaway for me is definitely to do our own industry-specific research to find out what are the implications of the how it will pick up, right, for our specific industry. So for me, it's software and software tools. So that's what I would be doing. So thank you for that. Thank you for the food of thought. So this brings me to the next events. On 7th of August, we'll be starting with the German-Indian Startup Connector, which where we will have two startup founders share their stories with us. And on the 13th of August, we'll have the third In Conversation with event, where we'll have Mr. Mohit Yadav, who is the Consul General of India for the South German region, having a conversation with GIBF. So with that, Andreas, Holger, and to UniCredit Group, thank you very much for sharing insights and talking to GIBF from the complete GIBF team.
Yeah, you're welcome. Bye-bye.
Bye. Thank you.